Patrick Zoolander, a model, idiot.
I'm your fool. It makes me crazy when you act so cool. Come on, baby, let's not fight. We'll go dancing, everything will be alright. Wake me up before you go. Don't leave me hanging on like a yo-yo. Wake me up before you.
Hey guys, welcome back to the Capital Mindset Show. Today we have something special for you guys, and it's about hedging, right? And particularly, it's about energy and how you can use energy to hedge your portfolio under specific circumstances. And we're going to be looking at a case study, basically, of how that has been done in the past. And this is kind of in response to, but not directly in response to, Rob the Popular Investor, which is a great channel. He had a video come out about his energy thesis and some of the investments he's making. We'll actually discuss the stock he discussed in that video, but I recommend you actually check his video out because he goes a little harsher on some things that I won't go into, because him being from Ireland, sometimes the comments he can make will not be seen as political as if I were to make those same comments. So I will refrain from making some of the comments he's made, but I'll touch upon them a little bit. And basically where I want to begin with is a statement that a lot of the stuff said here is going to kind of coincide with the research done at my work. And I won't be able to disclose exactly what we did at our work or the exact resources that we utilized to find some of this information, but I can share some of the details with you guys here. But just bear in mind that that's the best I can do. We will do a portfolio reveal sometime in the future, Austin and I. I had been hesitant to do something like that because it's technically like an argument from authority. So I'm kind of seeing maybe I show just a piece of the portfolio, not the full portfolio, but maybe, you know, what's the point? Just show the whole portfolio. But I wanted to refrain from doing that because if you guys agree with me, it's because of the content of what I'm saying and it makes sense to you guys. But I understand that sometimes you got to show something to say, okay, well, this person knows somewhat of what they're talking about. Now, that being said, we're going to talk about energy today. And before we delve into that, I want to go over a very basic topic that some of you might have covered in your microeconomics class in high school or maybe in your university classes. And I just want to cover a brief introduction to that for those of you who may not have taken us. So we're all on the same page here. So basically, I'll draw a basic economics graph, and the original demand curve is drawn like this. So gradient of -1. And for those of you who've taken algebra, a gradient or slope of -1. But when we're dealing with energy, what we're really dealing with is a inelastic demand curve. So it's a little more slope than that. So it's drastically more negative gradient. And the idea or premise you can take from this is actually what, or oil typically in those classes is used as a common example for inelastic demand. And oil, let's say in theory, the theory of economics, right? A drastic change in price will lead to a less drastic change in quantity demanded, right? So I'm being a little, trying to showcase the extrema here, but a drastic change in price is not, has a less drastic change in quantity demanded. Quantity demanded still goes down, but not as much as the increase in price. So basically, in the mathematical terms, the delta or the difference between price is greater than the delta or difference in quantity demanded, right? So that being said, this is how you can kind of think about the industry as a whole, that humans need energy to survive. We need energy to fuel our cars. We need energy to fuel our homes, etc. So in other words of how a company, a large oil company, can increase their profits, we actually have to talk a little bit about what are commodities. Well, commodities, what makes them interesting is that one commodity is the same as another commodity. I know that branding can play some role. Some people care that their oil comes from this place and that place. But for the most part, the consumer doesn't really care. And for the most part, the oil functions the same place, regardless of what oil it is. And I'm talking about the consumer end, because I know on the production end, some of you who are maybe petroleum engineers are going to say, well, actually the oil in Venezuela is different from the oil in Saudi Arabia because of the process that it has to go through. I'm not talking about the production side, just the consumption side. So now that we established that, going forward, let's talk about commodities and how oil is oil is oil is oil. You'll hear me say that phrase every time I mention a commodity. I'll just replace oil with extra commodity, whatever commodity. And that statement, kind of remember that. Okay, so basically the only way for a price, right, to really go up, or for producers to really have power, is if supply can come down, right? If everyone agrees to supply. So that's actually what the establishment of OPEC was. OPEC was a cartel established to control the production of oil so that they could control price, because otherwise you can't control price. Price cannot be shifted or risen by companies or countries in this case without actually losing market share, because oil is oil is oil is oil. So what happened? So I want to actually point to the a little bit of the backdrop. So within the United States, we'll actually use ExxonMobil, and I think ExxonMobil actually shows us the situation really well. So let's take a look on the max chart here when it loads in. There we go. So from 2014, we know something happened here, right? Does anyone know? I'll pause here. And if you guessed, that's when the United States was huge, or started becoming huge in shale oil production and started to become energy independent, you'd be correct. This is the beginning, and you can see how the large oil company share price followed in line with the trend. So before we go forward from here, you can kind of see that United States is a risk for the large oil companies. If the United States comes back online in production, this trade can become very risky, and it can produce negative returns, because again, it's a commodity-based trade or commodity-based investment. It matters the production, or the global production of the commodity. So United States has a tremendous amount of potential, along with Canada, to produce a lot of oil, and you don't want to discount that as a non-threat, right? OPEC is OPEC, and OPEC's going to do what OPEC does, okay? But the United States and Canada, I'll call these countries rogue nations, right? Well, not rogue nations in the literal definition of rogue nations, but rogue nations in regards to OPEC from the perspective of OPEC, okay? So I know some of you are like, they're not rogue nations. That's not the definition. Yeah, I know. They're rogue nations from the perspective of OPEC. So that being said, I want to go over two companies, right? But I'll give you a little bit of a brief rundown. You can kind of see here, right, in the past 5 years, there was a moment in time when you could have purchased ExxonMobil, or I tell you, all the oil companies. You can do this on your own. You can look up the ticker of any oil company or any large oil company with large production outside of the United States, and the same story will pop up. So basically, I'll talk a little bit about the research we did. What we found was, in aggregate, the incumbent president had the majority of donations from oil companies to them, right? But when you looked deeper at the components of those donations, what you actually found was the incumbent was made up of larger group of smaller oil companies, domestic United States oil companies. So in aggregate, when you added them all up, you would see that the total donations by oil was larger. Now, when you looked at the components of the other one, the current president, the components from that was made up of primarily international large conglomerate oil companies. And so that got us thinking, and we did more research. And we came back to that concept that we talked about at the beginning of this video, okay? And that oil is inelastic. So remembering the fundamentals, like I repeat in other videos, is sometimes very important, can make you a tremendous amount of money. And in this case, it made us a tremendous amount of money from both call options, common stock, being long common stock, and the meager dividends that we received alongside those common stock. But for the most part, it was from capital appreciation. But that being said, how could someone at home tell without paying for such research? Well, in order to kind of think about this logically and develop a logical framework from which you could drive or arrive to the same conclusion, you could remember the concept of the inelasticity of demand, and you could look out on the world and see, okay, well, are there changes happening so drastically that tomorrow people won't need oil? And remembering the inelastic demand curve, you will basically be answering the question without knowing it, that the demand curve won't change its nature. It will still be inelastic, and demand will maybe shift at growing at 1% per year, without even including that Asia is a massive powder keg of explosive growth, and all those people are going to need energy to live their lives. So you consider all of that, and then you say to yourself, well, if an individual party gets power, or an individual gets power that is planning on instituting certain policies and establishing sentiment's very important, but establishing sentiment that may be unfavorable for capital investment going forward, then you could conclude that the demand will remain the same, but supply will drastically change. And capital investment dropped drastically within the United States. So Rob was talking about this. Rob said it in a little bit more colorful way, a little bit more critical of the current administration. I won't partake in that language because, again, it's not a political channel. But the point is, how do we make money from it? How do we make money from something we see, or an observable phenomena in the world? And then this is one of them. This is one of them, and it's one that at the company portfolio we were very successful in, and my portfolio was very successful, and it's fueling current investments. So I have a lot of cash piles that I can then invest into other things like Activision, that everyone knows that we're actually investing in here at the channel. So oil, I think, made up a total of 20% of my portfolio investment at the time, and then it ballooned, and then I scaled back, and now it's down to about 10% of my portfolio as of, I think, 2 weeks ago. So today is the filming. It's 11/27/2021. So that gives you a little bit of a time frame. But I'll talk about some of my investments that I won't be going over today for different reasons. But I invested in ConocoPhillips, Gazprom, and Occidental Petroleum. Those are the three oil companies that I invested in. And I invested them in early November of last year. So the reason why I just now sold off a bunch of them was because they passed the 1 year mark, and then I had favorable taxes. I accidentally timed it from the sell-off on Friday. It was completely by accident. And I didn't know that this was going to happen. I don't even think that it's fundamentally changing the story, and I'll get into that in just a second. But the purpose of me selling and scaling down my portfolio, or those positions for my portfolio, was they passed the 1 year mark, and then I could pay a significantly less amount in taxes. And I wanted to deploy that capital elsewhere and also hold some more cash. That redeployment is actually the majority of it. But going back to what's going on, well, people have been talking about the crude oil price coming down, and what does that mean? What does that mean for the gas prices at the pump? Well, it doesn't really mean much. As everyone probably knows by now, I hope you know that the negative crude, or WTI index for crude oil, was not actually negative oil prices. That's not how it works. It's a derivative market. So without getting into too much detail, the point is, no, it does not reflect. It is kind of a good smell test. Over time, it kind of reflects it, but not necessarily. So we want to make sure that we kind of have a clear mind about that. And that maybe coincides with the coordinated deployment of world reserves right now. So it's probably correlated with that. It may be also correlated with the newer restrictions on travel because of new variants. So just think about all these things, and that's basically maybe affecting, because that can affect the demand side of the equation if you restrict travel, for example. So, but to give you an idea, United States consumes about 18 to 20 million barrels per day, something that for some reason our government official did not know, but it's publicly available information that is the range. And so when someone's asked that, they should have the answer for that. I mean, I assume if they were working as the energy secretary. But that being said, there you have it. The numbers are kind of there with a $50 million barrel deployment by the United States shouldn't really be too much of a dent. It's just a couple days worth of supply. So if you're bullish on the sector, this doesn't really change much. Okay. Well, whether or not I'll scale back in depends on the price I get, but right now it's not that big of a position in my portfolio. I still hold some. I'm not planning on selling it for various reasons because of the role it's going to be playing. But it's almost about 10% in totality when you add up Gazprom, ConocoPhillips, and Occidental Petroleum. But Occidental Petroleum is the one that was scaled out of the most. So yeah, we will talk about Oxy and another, I'm sorry, not Oxy, ConocoPhillips and another one. But if you guys wanted me to do an analysis on Occidental, I'm more than happy to do one. I just didn't think it was as high of a quality of a company, so I left it out. Okay, so the first company we're going to be talking about is ConocoPhillips. And like I said, I'll let you guys, well, actually, we'll look at the price movement over the past year or so together. And again, I'll say that if you grab any of them and around the same time period, that was it. So in the company, we kind of had a strategy if each individual won. And then our strategy for the current president was investing huge in oil companies. And so if you kind of can take a step back, and I think Buffett said it in an interview in 2019, don't allow politics to get in the way of your investing. You want to just take a step back, separate yourself from the situation, and think about ways that you can profit from the situation, and leave your opinion at the door when you're investing, right? Of course, you know, I say that, and your opinion is obviously very important because you, at the end of the day, have to make the choice. So you know what I mean by opinion. So in good faith, I'm saying that. I'm saying, assuming that everyone knows what I mean. Okay, so let's go to ConocoPhillips and let's take a look at them in the model. So I already had it pre-filled. And something that we want to be talking about is the growth rate. So the growth rates are very important. So currently at the current price of $71.48, if you assume a 15% required rate of return, you can assume about 11% growth going forward, and then the model tells you can buy it. Even assuming a negative 1% dilution, so they're diluting you by 1% every year for 10 years, it does pan out well for you. I don't want to assume, or I don't think I would assume greater than 11% growth rate for this kind of industry, or sorry, this kind of company. They are scaling back their American positions. And as I've been saying, the sentiment matters. If you don't think the sentiment matters, you're sorely mistaken. The sentiment matters for capital investment. If I don't think the administration's on my side, why would I invest in the United States? I'll rather invest in other countries. Like Denmark, for example, is a huge investment for ConocoPhillips. They just did a collaboration earlier this year with the government of Denmark for an offshore natural gas discovery, one of the largest in the world. Exactly. So my other investment, Gazprom, is a large Russian gas company. And if you've watched Sven Karlin's videos, he talks about that one a lot. I like the company. I don't know why some people, for example, think that Russia's a sketchy place to invest in, but China's not. You know, I mean, you can go look at our China videos and you can learn more about that there, but I'm not getting into that in this video. But Gazprom was completely separated from the United States. However, it coincides with the United States not supply shortage, but coming offline, as I call it. So I also benefited in that investment from the new administration approving Nord Stream 2, which was disapproved by the previous administration. So I was investing or accumulating Gazprom a little bit before the other date. And I did enjoy the dividends that were coming through, but then I invested more heavily, again, following the same thesis with ConocoPhillips and Occidental Petroleum. So actually, I want to go over with you guys, because I know you guys maybe want to see this, the key ratio, so we can take a look at the health of the company. So I want to tell you right now, of the companies I mentioned, ConocoPhillips is the most healthy. So you're going to see the best numbers now, and things are going to get worse when we look at Transocean, which is the other company. But current ratio, cash ratio, you can see that even the cash ratio, they have enough cash on hand to pay their current liabilities. That's pretty healthy. Total debt ratio, the balance sheet getting better every year. Gross profit margin, all of that. The profitability ratio is pretty solid, but we want to see some improvements. We do not see some all-time highs, but we're seeing some improvement there. Let's look at the earnings quality, the metric we love here that I made to help myself give a grade to management and how they report the numbers. So earnings quality is 2.74, fantastic, I love it. Now looking at these, the inventory measures. So we see basically across the board, things are getting better, things are good. I like to see that. If you guys can pause here and you guys can look at each individual one, I'm only going to talk about if it's something that's super important or, you know, pertinent to the model. I don't think anything really sticks out here. It's just really good. All right, so the next company is Transocean, and ticker symbol RIG, so RIG. And this is the one that was featured on the other channel, The Popular Investor. And let's talk a little bit about the company first, one-on-one, and something. It's pretty simple what they do. You can kind of think of it as it's an offshore oil company. And so the thesis behind this is fairly simple, but makes sense. It does make sense. So if the sentiment in the United States gets negative around oil, then the producers are going to want to fill that demand still. Don't think that they're just going to, you know, give up, put their hands up. No, they're going to adapt. And one of the ways that they can adapt is through offshore exploration, right? There's so much in the ocean that we still haven't found. And this is basically what Transocean focuses on. This is their entire business model of what they seek to do in order to get that production online and then supply the demand. Okay. So why is this important? Well, going forward, we may see a ton more investment, and we did see the management do an investment of about $200 million of their own money into the company. Now, is this a bullish indicator that means you should go out and buy the stock now? No, don't do that. Do far more research than just that, okay? But simply saying, it is interesting to see that management is buying or putting their money where their mouth is. Now, when I see the prospects of the business, I do see some bullish indicators. I do see the thesis, okay? However, there are some things that I want to be cautious about, okay? Again, a president in the United States only lasts 4 years, and even then, the president is perfectly capable of changing their mind and changing their policy. Policy can change, okay? Policy can change if, quote unquote, the facts change, right? So, or the facts change, whatever's politically viable. So remember that politics can change the course of actions of politicians. So we want to be cautious that the United States at any moment can change how it's, you know, handling its production. And all of a sudden you have to deal with all this production coming back online. But if you think the damage is permanent, then that risk perhaps is dampened down a bit. But that just depends on you when you're thinking about this. So let's take a look at Transocean. And the model, I already pre-filled it again. So with Transocean, let's pull her up right now. Okay, so this one, I want to highlight how cheap it is. Okay, we're going to see in a couple ways of how cheap it is, but it's extremely cheap. So if you think, or if you somehow know that the offshore environment's going to get better and better and better because of the reasons I just laid out, then the potential returns are going to be very drastic. So Rob, the Popular Investor, if you're right, you're going to make a ton of money on this. Okay, and I bet you that's what he's probably hoping for. So I'm looking at this thing and I can see, okay, I can discount this thing at 30% and I don't have to assume much growth. 5% growth is nothing. So I don't have to assume much, and I can make that happen, right? I can get there. Now, I'm not assuming any share dilution, so I don't know if they're going to need to do that. I will tell you again, like I already told you, ConocoPhillips has a very good balance sheet. And when we look at this company, we're going to see, you know, a slightly worse balance sheet, but something not to, you know, be super happy about. So let's take a look real quick at those key ratios, and we'll take a look first at the balance sheet ratio. So liquidity ratio, You see already the cash ratio is not that good, but the current ratio is pretty good. That's almost 2 times coverage on their current assets over current liabilities. The long-term debt ratio, it's getting worse, but not that much worse. It's actually just about the same as ConocoPhillips, which is surprising. It's very good. Long-term debt ratio, also getting worse from 2017, but getting better from 2019. Okay, so give or take. And then debt to equity, we see, you know, a little bit getting worse, but you know, it's still pretty good. Long-term debt to capital, same story, and basically same story across the board, but getting worse from the longer term 2017 to now, but getting better from 2019. And then gross profit margin, we want to see that that's in the red flag. I don't want to see that happening, but that could be because of the fluctuations of oil pricing and their investments that they're doing. So we need to see, because the way that they may be capitalizing the cost of the production of the product. So that's some details we need to figure out. And let's take a look at the earnings quality. So earnings quality, I'll tell you right now, by this metric, it's good. Okay, it's good. We want to see these numbers right here. So it's good. It's improving and it's good. Okay, so now let's take a look over here, and I'm not gonna really, this is just for you guys to pause if you want to look at this. I'm not really going to talk about anything over here. Let's skip over that, but pause here if you want to look at it and you can see if things are improving or disproving. But for me, nothing really too much. Oh, there is one thing I glossed over, but here you go. So the book value per share. Now, this is very interesting. Not only is this kind of troubling because the book value has declined by about half, it's also tremendously higher than the current stock price. Now, I'd have to do a lot more research on this book value, okay, to make sure that it's actually the true book value, and kind of be more conservative with it as possible, because if this is truly the liquidation value, it's just a testament to how cheap this company is, okay? So this company no doubtedly is cheap, but it may be cheap for a reason. And so we want to look at this price to free cash flow. It's about 4, you know. Now, as the cash flows, are they going to keep coming in at the same rate? Maybe not, but maybe they will. Okay. So going back to this, I mean, we can soften our estimations, and we can actually try to say, let's see live if we can assume some declines. We can almost assume a decline of 5% per year, which is pretty crazy. And then let's take let's see, the average growth for the past 5 years is negative 5.6%. So let's put negative 6% in there. Okay, and then let's assume, let's see what the buybacks have been. So average buybacks is negative 15%. All right, fair game. Let's go. Let's see what it's like. Yes, and let's do negative 15%. So let's see if they continue what they did in the past. You see how the story can change and how the buybacks can be very detrimental to one's earnings or one's returns over time. So even assuming these buybacks, I'm surprised because I'm still discounting at 20%. So you see, we do a market rate of return. Well, now the 10% makes sense, but the 10% is probably not going to be the case. So if I assume a 5% decay in cash flows, I'd have to get this thing at $1.38. And then I'd see a decent margin of safety. However, let us say if this changes to still diluting you, but only by 5%, right? This is probably what he's thinking, right? This is probably what Rob is thinking. So, or somewhere along the lines that Rob is thinking. And he thinks that the cash flows are going to actually grow going forward. And let's assume about 4%, right? So 4%, and then I think you have to assume 5% to generate that rate of return. Yeah, so that's within the margin of error. That's like a day's worth of price action for the company like this. So about just above 5%, and you can still assume a 5% decay. You cannot assume a decay in cash flows in order to get that kind of return. But it is interesting to see, and we'd have to do a ton more research on that book value to really see if that's the actual liquidation value or if that's just management being aggressive with certain things. But I'm pretty sure the model's accounted for a lot of it, but I need to actually go in and make sure that some of the values are reliable, right? Reliable from what management is reporting. And that will take a little bit of legwork. But this is an interesting pick. I'll just say that. Will it make it into my portfolio? Not right now, but I will say my mind tends to change as the facts change. And if I do more research, and if you guys want me to do a follow-up video, comment down below. If you guys have any questions on the other companies mentioned, comment down below. If you want me to do an Occidental Petroleum video, you comment that down below, and I'll be sure to get that content out. If you guys have any questions regarding inelasticity of demand or how that affects the industry, be sure to comment that down below, and I'll get back to you as soon as I can. I've been working kind of long hours lately, so getting back to all the comments when I can it's been difficult, but I've been trying. So bear with me, guys. But yeah, this one's an interesting company. ConocoPhillips still in my portfolio, and I still have some Oxy and Gazprom. With that being said, guys, thank you guys for watching. You made it this far. Be sure to like the video if you guys like the content. It helps us grow a lot. And thank you guys. Have a good one.